Alright, so if you've been watching my channel for some time now, then I'm sure you know that I'm a huge fan of selling naked options, which is basically just selling a call or selling a put without at least initially having a corresponding stock position in the case of selling calls, or locking up the full amount of capital necessary to potentially purchase 100 shares of stock when selling a put option. And the reason why I'm such a fan of this approach is because there are simply so many benefits that come when you do sell naked options. Like, for example, you'll collect a much higher credit and therefore your profits will be much greater on average. You also have a much higher chance of turning a profit on every trade. It's also much easier to make adjustments, etc., etc. But that being said, you of course still have that one major downside, which is the fact that you do carry undefined risk with these kinds of trades, which means, especially for selling a naked call option, you have theoretically unlimited loss potential. And that can definitely be pretty scary for a lot of new options traders, but I would argue, and as I've said many times in previous videos, that's only in the case though if you do nothing to defend a trade. And so that's why in this video here, I'll show you exactly how you can defend a short naked call or a naked put by using the corresponding stock. And the approach you're going to see in this video is my own personal approach that I use in my own options trading. And I can say from experience that using this method has not only saved my butt from what would have been very large losses, but also this approach can allow you to still profit on a trade even if you are super dead wrong on the direction of the stock. Now, as always, before we get started here, in case you are brand new to the channel, my name is Scott Reese, and I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in case you want to see more trading or investing content after watching this video, you can also find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. Alright, so now let's walk through some very basic examples so that way you can see generally how this approach works. And then after that, we'll jump over to ThinkOrSwim here, and then I'll show you how to create the exact orders that you'll need to pull this off. So beginning first with selling a naked call option, and keep in mind, when you sell a call option, this means you are obligated, you must sell 100 shares at the strike price if you are assigned on the contract. And this typically happens, of course, by the expiration date if the option is in the money, or if the stock price is above your strike price. So let's say, for example, you sell a naked call option on some stock with a strike price of $100, and for doing so, you collect $300 in premium. And moreover, at the time you place the trade, the stock is trading at $90 per share, a full $10 below your call strike. So therefore, as long as the stock price stays below your call strike, then there's nothing you need to do on the position, right? The option will eventually expire worthless, and you'll just walk away and keep the full $300 in premium. Moreover, even though this position is ideally bearish, right? You want the stock to go down in price, but it can also trade sideways or even increase in price slightly, and you'll still walk away with that profit by the expiration date. But now let's say we fast forward to expiration, and by this day, the stock has actually skyrocketed all the way to $200 per share. And so, like I explained, if the stock price is above your strike by expiration, you will get assigned on the contract, and therefore you have to sell 100 shares of stock at the strike price. And of course, with this being a naked call option, that means you did not have any stock position prior to selling the contract. So that means in order to sell those shares at the strike price, you must first go into the market and buy them at the market price of $200 per share. So once you pay that lofty price to purchase the stock, now you can turn around and sell them at the strike price of only 100. And therefore, the final outcome of this trade by expiration is you initially bought the shares at a price of $200 per share. You then sold them at a price of only 100. So that's a loss of $100 per share times the 100 shares for the one contract. And then you do also get to keep the $300 in premium. So we add that on. And in the end, this creates a loss of $9,700. That's a lot of money. And again, this is just for selling one contract. But now let's say instead of doing nothing to defend this trade, like in the first example, let's say after you sold that call option, and once the stock price rose to $105 per share, at that point you then purchased 100 shares of stock. And then same thing, by the expiration date, the stock is now at $200 per share. So in this example, you basically converted your initially naked short call option into a covered call option. And as you'll see here, it therefore does not matter how much higher the stock price goes after you purchased it. So come expiration, when you get assigned on the contract, the final outcome of this trade now is going to be you bought the shares at a price of 105, and then to honor your obligations on the contract, you then have to sell that stock at only 100. So that's now going to be a loss of only $5 per share times 100 shares. And then finally, again, you keep the full $300 in premium. And now this creates a loss of only $200, which of course is much, much more manageable. Okay, so that's the example for selling a naked call option. Now what about selling a put option? And keep in mind, when you sell a put, this means if you are assigned on the contract, you must now purchase 100 shares of the stock at the strike price. And this mostly happens, of course, by the expiration date if the stock is actually below your put strike. And so for this example, we'll keep things very similar. Let's say you sell a put option with a strike of 100 and you collect $300 in premium for putting on that position. Moreover, at the time you place the trade, let's say the stock was trading at $110 per share. So that's a full $10 above your put strike. So therefore the stock can go up in price. That's what you want ideally, or it can go sideways or even down slightly. And there's nothing you have to do to defend the trade. But once again, let's fast forward to the expiration date. And unfortunately, this stock has dropped from 110 down to only 50. So of course, you're going to get assigned on this put option. And like I said, you will have to purchase 100 shares of stock at the strike price at $100 per share. And if you then did not want to keep those shares, you have to sell them at the market price of only 50. And so in this case, the final outcome of this trade would be you bought the shares at 100 and then you sold them at a price of only 50. So that's a loss of $50 per share times 100 shares, and then also add on the $300 in premium. And in the end, you would lose $4,700. But in a very similar fashion with the naked call option example, let's back up a bit and let's say when the stock fell from 110 down to 95, at that point you shorted 100 shares of the stock. So this is how you defend a short naked put option. It's just the opposite of defending a naked call. So instead of buying the stock, you actually short the stock. And I'll show you how to do this in ThinkOrSwim in a moment, but the way short selling works is you first borrow the stock from your broker, you then sell it immediately in the market. So again, this is the opposite of buying stock first, and then to close out that position, you actually buy the stock back and return it to your broker. So again, in this case, if you shorted the stock at a price of $95 per share, the final outcome of this trade would now be as follows. Again, a short sale price of 95. And then to honor your assignment obligations on the put option, you have to buy those shares back at a price of 100. So now that's a loss of only $5 per share times 100 shares. And then of course, add on the $300 in premium. And therefore, in the end, this creates a loss of only $200. Much, much more manageable. All right, so those were the two examples I wanted to show you first, and I hope they made sense. So now at this point, we're going to jump over to ThinkOrSwim, and we'll take a much more detailed look, and I'll show you how to create the actual stock buying or shorting orders to make this all very automated. So let's get started. All right, so for my examples here, the stock I'll be using is going to be Airbnb, simply because this stock typically has very high implied volatility, and therefore that makes it a great candidate for any kind of options selling strategy. And then also, if we take a look at the current stock price, right now Airbnb is sitting at around $167 per share. And not too long ago, the stock was only at about $135 per share. So in just 4 days here, this stock is up by almost 25% and perhaps is due for a short-term correction or a short-term sell-off. So that's why, for me at least, I would be potentially interested in selling a short naked call option to play the stock to the downside. And so therefore, let's now come over to the trade tab and take a look at the option chain for Airbnb. For this example, let's go into the April monthly cycle with only 26 days left to go. We'll unfold that tab. And again, to play the stock to the downside, perhaps I want to sell this call option right here. This is the 180 strike call. And I could sell this contract for about $420 of credit. That's pretty good. And again, that's because the implied volatility for the stock is still pretty high. And of course, also, with this stock only trading at a price of $167, that means Airbnb can increase by a full $13 before it even reaches my short call strike. So in that sense, I can still be directionally incorrect on this trade to some degree and still not have to do anything to defend this position and still walk away with a profit. But with that being said, what if I'm just super wrong on this trade and Airbnb goes from $167 to $200 per share by the expiration date, or to $250? Who knows? There is no limit as to how high a stock price can go, of course. So therefore, like I already explained, if at some point I purchase 100 shares of Airbnb stock, then at that point, it does not matter how much higher this stock goes beyond that purchase price. And so now what I'm going to show you here is how you can place an order that will automatically buy those shares for you at a certain price point that you set. And in that way, you now don't have to just be glued to your screen and wait for Airbnb to hit that price point and then send in the order manually. And so what I can do here is come up to the current price of Airbnb and click that, and then go to buy. And that brings up a buy order down below to purchase 100 shares of stock. And by default, this order is a simple limit order, and we're going to have to change this. So I'll just click on limit here, and now I can go to stop limit. And now as you can see here, there are two prices that you must set to complete this order. The first price is the stop price, STP. And this is the price at which if Airbnb rises above, at that point, then this entire order will become active. So if my call strike is at 180 here, perhaps I want to buy the stock if it reaches a price of 185. So therefore my stop price would be 185. And then again, if in the case where Airbnb rises above 185, this order will now try and purchase 100 shares of stock. And that's where the second price comes in, the limit price. And this price here is the highest price that you are willing to pay to buy those shares. So typically what I do is just set this price $1 above the stop price. So I would set this to 186. So one more time, the full picture here is if Airbnb rises above 185, then at that point, this order will try and buy those 100 shares, but this order is also set to not pay more than 186 per share to buy those shares. So this price here basically just ensures that I do not substantially overpay to buy this stock. And then also one more suggestion I would make is to change this here from STD to mark. And what this will do is it will judge the price of the stock based on the actual bid and ask prices here. Specifically, the mark price of a stock or the mark price of an option is right in between the bid and the ask. That is also considered to be the fair price for the stock or the option that you're buying or selling. Whereas with the STD price or the standard price, I believe this refers to the last fill price. And basically the bottom line here is that choosing this kind of order type can sometimes cause your orders to get filled at very weird prices. So my experience using the mark price will give you much more accurate and much more reliable fills. So that's why I always use mark pricing. And then also one final thing to mention is whenever you are trying to buy stock with an order, you can actually change this to a GTC order, meaning this one will always stay in place until it either gets filled or you cancel it yourself. Otherwise, if this was set as still just a day order, then every day once the market closes, this order will expire. And that means come the following trading day, you'll have to recreate this whole order over again. So again, just to make your life a bit easier, I suggest keeping this as a GTC or good till cancel order. And that way, you just have to make the order once and it will always stay in place. And so once you have that order configured, you can simply confirm and send it, and now you're good. You don't have to be glued to your screen and wait for Airbnb to hit 185 bucks per share. This order will take care of all that for you automatically. But then this raises the question of, okay, what if Airbnb does indeed rise above 185 and you buy the shares of stock, but what if at that point the stock reverses and goes back down? Well, that means you're now going to start losing money on those long shares of stock, and given that this trade was initially meant to be bearish, you want Airbnb to go down in price, well, at some point you'll have to sell those shares and remove this stock hedge. And so the way you're going to sell those shares, if indeed the stock does reverse after first buying them, is you're going to once again use a stop limit order. So we'll go ahead and delete this. And so now we're going to assume you've already purchased those 100 shares of stock. And at this point, come back up to the current price of Airbnb, click that, and now go to sell. And down below, this brings up a sell order to, of course, sell 100 shares of stock. And then again, we just make it a stop limit order right there. And the stop and limit price here function in the exact same way as with the buying order. So the stop price is going to be the price at which once Airbnb falls down below, at that point, this order will become active and will try to sell 100 shares of stock. So perhaps if Airbnb falls back down to a price of perhaps 180, at that point, I want to sell my shares. And then also, I don't want to sell those shares below a price of perhaps 179. And then same thing, change this STD pricing to mark pricing. And also I can still make this a GTC order because I have first purchased 100 shares of stock. And there we go. Now I just hit confirm and send in the order. And so keep in mind here, if all this stuff played out and I first purchased the stock at a price of 185, and now with this order, I'm going to sell them potentially at a price of only 180, that means I will lose $5 per share times 100 shares. That's a loss of $500. That's quite a bit. But of course, don't forget that you do also keep the premium for selling the call option, as long as you hold it to the expiration date. So if you lose $500 on the stock, but you keep $420 from selling the call option, the net effect is you lose about $80. Not a big deal. But you can definitely set the prices of your orders in any way that you see fit, right? For example, you don't have to lose $500 if this kind of thing happens. You can instead set your prices such that you would only lose $100 or $200. It's up to you. Moreover, you also don't have to buy or sell the full 100 shares right out the gate. You can do a smaller amount if you want. So if in this case, if Airbnb rises above your call strike and you first only want to buy 50 shares of stock or 25 shares of stock, you can do that. And then if the stock continues to rise after that, well, you can buy more shares at that point and keep buying more and more and more until at some point you then have the full 100 shares of stock in your portfolio. So again, what I'm showing you here is just one basic example, but there are tons of ways you can customize this approach to fit your risk tolerance and your objectives. And then a very cool feature that comes with ThinkOrSwim that I have not found on many other platforms is, let's say again, I want to first set up my buying order to buy 100 shares of stock. If Airbnb crosses my call strike here, so same as before, come up to the current price, click on that, go to buy, and then I'll quickly set up this order here. Okay, here we go. Buy 100 shares. If it passes 185, limit price of 186, mark pricing, and a GTC order. So same as before, but now coming down here under advanced order, right now it's set to just a single order, but I can change this to a first triggers sequential order type. And now this means I can add more orders underneath this one. So this one here first buys the shares of stock, but now I can set up a second order that will sell the shares if Airbnb reverses. So now I come up here and click on the price once again and go to sell, and there you go. And now adds that second sell order to this full package right here. So once again, let me go ahead and configure this order. And there we go. My second order now will sell those 100 shares if Airbnb reverses and falls down below 180. And now I can confirm and send this whole thing. And the way this will work is these orders here will execute sequentially, hence the name first trigger sequential. This first order here, once it gets executed, will trigger this second order. And now this one will become active. So basically this sell order here will not be considered, will not be executed until this first one does. And now in this way, you are basically setting up a chain reaction of orders that can execute automatically. And therefore, you don't have to set up each one of these orders individually every time, for example, you get an alert that one of these orders got executed. And you can also just keep adding more and more orders to this chain. So now, once again, come up top and click on the price and go to buy. And boom, there you go. It adds another buy order, which I'll go ahead and configure. And there you go. So now we're going to buy the shares of stock if it passes 185. And then if Airbnb reverses, ThinkOrSwim here will automatically sell those shares at a price of 180. And then if after that Airbnb reverses once again and goes back higher to 185, ThinkOrSwim will buy those 100 shares once more, and so on and so forth. Now, like I mentioned, every time a buy and sell order gets executed, you're going to lose $500, which is a fair amount of money. And so that's why I personally would set these prices to be a bit closer together. So for example, instead of buying the shares at 185, I might buy them if they reach a price of 182. And then I would change my limit price to perhaps 183. And then same thing with this order down here, 182 and 183. So now if I buy the shares at 182 and sell them at 180, in this case, I'm going to lose $2 per share times 100 shares. That's a loss of 200, which is only about half of my starting credit. So that means this whole sequence here can happen 2 times before I even lose my full starting credit. And after that point, I can make additional adjustments to this position to take in additional credit to compensate for those losses. And for example, what I would do in that case is sell a put option, right? For instance, by selling this 155 strike put option, I would collect an additional $470. But that being said, adjustments and whatnot are not the focus of this video. In this one here, my primary focus is just to show you how to set up these kinds of buy and sell orders. But if you do want to see a much more in-depth look at my overall strategy, which includes these kinds of adjustments, then you can check out pretty much any of my live option trading videos. And lastly, in this video, I know so far we've just focused on covering a short call option that goes in the money, but now what about a short put option where the stock falls below your short put strike? Well, in that case, let's say I did go ahead and sell this 155 strike put option. So now, like I said, if Airbnb falls below my put strike of 155, at some point I would short sell the stock. And the way you do that is basically the exact same way that I showed you right here with buying stock, except the first order here is not going to be a buy order. Instead, it's just going to be a sell order. So let me go ahead and delete this. And now we'll come back up to the top and click on the price of Airbnb. And now we'll just go to sell. And there we go. That brings up the sell order down here. Let me go ahead and configure it. And here we go. So by creating an order that is set to sell 100 shares as an opening trade, that means what's going to happen here is I will short 100 shares of the stock. And this order will get triggered or executed once Airbnb falls down below a price of 153, which is $2 below my put strike of 155. And that's it. Once this order gets filled, I am totally covered to the downside. Airbnb can go to 0 for all I care, and it does not matter. And then also, of course, once this order does get filled, at that point, you can just come back to your platform and create a new stop limit order to buy back the shares. Or if you are also using ThinkOrSwim, then definitely take advantage of this first trigger sequential advanced order type. So you can therefore simply attach the buy order right down below. So again, come back to the top here, go to buy. And here we are. I've already gone ahead and configured this order. And this whole thing is going to function in the exact same way as I showed you earlier when buying shares of stock to cover the call option here. Right? So we're first going to short shares of stock once it falls below 153. And then if Airbnb recovers and goes back above 155, then ThinkOrSwim will buy back those shares and close out my short stock hedge. And also one thing to note here, whenever you are trying to short sell shares of stock, for some reason, you cannot actually make this a GTC order. Unfortunately, it always has to be a day order, which means every day you'll have to continually recreate this chain, and then it will be in place for the entirety of the trading day. So a little bit of a hassle there, but not a huge deal because creating this whole kind of thing is still pretty quick. And just to reiterate here once more, these are all just examples, right? So you don't actually have to buy or sell the full 100 shares right out the gate. You can do it in increments, and you can also change your pricing to be whatever you want. And lastly, I would highly recommend, if you do want to try this approach, that you do so in a paper money or fake money account first. And that's just because this approach here can be a bit tricky in terms of setting up your orders correctly or getting your prices to be exactly how you want them, etc., etc. And the ThinkOrSwim platform here has a very, very good paper trading feature that I personally have used many times in the past. And it allows you to make very realistic simulated trades, stock, options, etc., all based on real-time pricing for stocks and options. So it's a very good way to practice this approach or really any kind of trading approach before you put real money on the line. And so with that being said, that's going to do it for this video. I hope you enjoyed it. And please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.